Hey, good morning, everyone. Marty Missouri here, Tuesday, the 26th of March, 2024, with your midweek market snapshot. Clients, this will come attached to an email Wednesday morning as the morning message. Going to keep it pretty brief today. I want to touch on the points I made in this morning's written commentary, then take you through the charts. Really can do the charts quickly. Not a lot, if anything, has changed. And you'll see what I mean here in a minute. So with regard to this morning's message, I prefaced it with there's really not much, if anything, to add to our last two videos, the end of week market snapshot and the economic commentary over the weekend. And to put it all in a nutshell, Powell is clearly comfortable setting market expectations at 3 rate cuts this year, in essence dismissing the latest inflation data. No longer, for the moment, concerned with an early 80s repeat. I touched on that a little bit in both of the recent commentaries. If you missed those, please go ahead and take a peek at those. I think they were instructional. I will, however, add that not all on his team are on board, and that's clearly not the case. Raphael Bostic comes to mind. He's thinking maybe one cut this year and maybe later in the year, if at all. So if that's going to become the prevailing sentiment, it's not at this point, but if it does become the majority view, which it would almost have to if the economy remains relatively steady and if inflation remains relatively sticky, they're going to have a tough time justifying 3 rate cuts this year. So we'll see how that plays out. Our base case is that ultimately the economy does weaken later this year or early next year, which will bring the inflation numbers down, but it'll also bring the earnings numbers down as well. And that's what we think is really ultimately problematic for stocks. The economic data are improving. We got a big pop in our own economic index, and we're seeing that particularly in the manufacturing space, and notably reducing the odds of near-term recession, likely just pushing the start date out further. Equity market technicals, and we'll look at the charts here in a second, and sentiment big time point to increasing odds of a pullback in stocks sometime over the next few weeks, given the fact that for the moment, recession odds have been lessened and on balance, accommodative Fed. All things equal, if we do get a pullback, and I'll be surprised if we don't, odds would indeed favor buying that pullback at least if you're a short-term investor in equities, given the overall setup that we're seeing in the very short term. So I would have to say, not immediate term, but beyond a decent dip, all things equal, I think stocks could continue their uptrend, at least into election time. Now, number 5 notwithstanding, there is what I would call a tremendous amount of leverage in this market right now, in particular in the derivative space. A cracking of certain levels to the downside could indeed spark something far more meaningful than simply a buyable dip. That said, and again, all things equal, odds still favor number 4, I think. Nevertheless, given certain elements of the overall setup, present macro conditions, the risks I highlighted above, and historically very high valuations, we need to accommodate via liquidity diversification and hedging for the fact that in markets, make no mistake, all things are indeed not always equal. So definitely need to stay on our toes as whatever's left in the present cycle continues to play itself out. And once again, we'll look at the daily chart. So we have, this rising, you can call it channel, maybe a little bit of a wedging action in there. That would be a bearish pattern to the extent that it's a wedge. We still have long bearish divergences, kind of ominous ones, quite frankly, on our momentum indicators. The recent buy signal here on the S&P is beginning to fade. As for the NASDAQ 100 tracking ETF, we had this uptrend line, this very definite rising wedge. Broke below that, probably give it the benefit of the doubt and do this here. And in which case, that's a legitimate trend line, I think, as well. It gets hit enough times in here. So we can look at it as backtesting the former uptrend line, or if you prefer this one, now it's finding support in that channel there or in that rising wedge pattern. Nevertheless, we have just even worsening bearish divergences here on our momentum indicator. So folks, this is a setup that more often than not results in a breakdown below these levels. You get these marginal new highs, you get these bearish divergences. Ultimately, the weight of conditions gets too much for the market to hold up. Small caps, Russell 2000. This is just a one-year chart, still way, way off their all-time high of a couple of years ago. You can see that small caps have been, fighting with some resistance right here. We had a rising wedge, big bearish divergences. Sure enough, took a move a few percent lower, battled right back. This was on favorable Fed news last week, and then finding resistance right there again. Still a sell signal, still bearish divergences on small caps. As for the all-important US dollar, there's not a lot to glean from this. I'm kind of ambiguous right here in terms of the direction of the dollar. There's some things going on globally that I think could impact it in one way or another, and I will take a look at the euro and the yen here in a second. Somewhat of a down day yesterday, just kind of fighting with this line right here, which is pretty important potential resistance at around 104. Nothing real telling other than does look like we definitely have caught some momentum here to the upside up until yesterday, clearly. This is a buy signal on the MACD from the right spot below this zero line right here. So that would be bullish. We'll see how it plays out. Let's look at yields before we look at the euro and the yen. So the latest economic data and the latest inflation data would suggest that yields should continue to move higher if that data continue to hold, or if it does tell a story about a new trend or perhaps a counter trend move, if you will. However, from a pure technical picture, this looks potentially pretty bearish to me. You can see we have waning momentum, and as I pointed out for years now, that would be something that would have me leaning bearish. You can see as we hit this 5% up in here, you can see momentum waning, and you can see what happened from there. Here we had a falling wedge pattern. We had momentum beginning to pick up, and sure enough, we've had a nice rally off of that spot. So it'll be interesting to see where yields go. To the extent that they go higher, ultimately, that should be very bearish for stocks. To the extent that they go lower right here, that would be very bullish. Ultimately, in a recession scenario, they go a lot lower, but keywords there being recession scenario, that's where lower yields by themselves wouldn't be bearish for stocks, but they'd be occurring during a very bearish period for stocks if we indeed had a recession. As for the euro, the reason you want to look at the euro, particularly when I can't really glean much from the dollar, is the euro is the predominant currency that impacts the dollar index. Also not anything to get too excited about in one way or the other. You can see it has been battling with its 50-day moving average here and failing off of that. That there would be a bearish sign if indeed it continues to decline off of that level. We do have somewhat of a bullish divergence when we go from this spot to this spot on the MACD, so that would be bullish for the euro. If indeed the euro were to rally right here, then that would be bearish for the dollar potentially bullish for U.S. stocks. The European Central Bank has been signaling that mid-year they're probably going to start cutting rates. That's been bearish for the euro. And then I wanted to bring up the yen. The yen is in the gutter. This is a multi-decade low for the Japanese yen. We can get into the weeds about Japan's yield curve control. They're no longer doing that, but they're still remaining, in my view, uber accommodative. So when they announced that yield curve control was no longer a thing for them, the market traded up in the days leading up to that, and then ultimately, as it happened, it turned out to be a sell the news event. The whole world is net short the yen versus the dollar. The yen is the funding currency for massive carry trades. They have been for years and years throughout the world, and that just means that investors have borrowed in very cheap yen. They can get it for virtually free loans, and then invested that in other jurisdictions where they can get a net spread that is profitable to them. What you'll notice is that in times of crisis, global crisis, the yen will rally hard because those trades need to come home, and the yen starts rallying, and that's very problematic if you borrowed in that currency and invested in other currencies. We've talked about this in the past. I don't want to spend a lot of time on that today, but if anybody ever wants to email me for clarity on some of this stuff, I'd be happy to accommodate. So, in fact, we took a position in the Japanese yen in our core portfolio leading up to COVID because we sensed something of a global crisis nature even before we knew about COVID. And we got a real nice pop out of that right off the bat. It was a several percentage point move that faded pretty quickly as all the stimulus started coming in. Structurally now, I think there is a case for a structurally stronger yen. The Japanese stock market has come back to life. The Japanese stocks are up like 20% year to date. Our Asia Pacific fund has been one of our best this year because of that. We actually cut that exposure by about 20% here last week and took a starter position in the yen. The yen is so cheap from virtually every angle, purchasing power parity, however you want to measure it. And structurally, things are changing in Japan. The way they're approaching their economy is changing. They've been begging for inflation. They're finally beginning to get it. To the extent that that continues over the longer term, and we are in the structurally higher inflation camp going forward, all things equal, that's probably going to be pretty positive for the yen. Corporate governance has changed quite dramatically. The way companies approach their stocks right now is a pretty bullish scenario for Japanese equities. As I mentioned, that's been huge so far this year. I think there's going to be a lot of volatility. Any kind of a small catalyst that would bring money rushing to the yen, there's going to be massive short covering, and we're going to see quite the rally in the yen. I have no timeline. I think we're probably early. I don't expect we'll make a lot of money on that position in the near term, but as things develop, it'll probably something we'll be scaling into more. I'm not making a recommendation for anybody to go run out and buy the yen. The trading in currencies is not uncomplicated because of the constraints we have and client portfolios. We do it via a currency ETF, but I'm not making that recommendation. If you're not a client, please do your own research, talk to your own advisors, make your own decisions. And folks, I will leave it there. Rambled a little further than I expected to. Hope it was useful or at least interesting to you. Hope you have a great rest of the day. Talk to you again soon. Bye-bye.